how the investing landscape has changed since 2017 and 2018. Obviously, things have gotten a lot more expensive. You have companies waiting a lot longer to go public. How does that change the strategy?
So I think in the past 2 years, what we've seen is a great public market for our late stage companies. And at Greycroft, we've had 2 IPOs. We had ICA in Hong Kong earlier this year and the Real last year. And that's, I guess, across the entire industry. Most VCs have had a handful of IPOs now, and the IPO markets are open. That helps with liquidity for us. It also helps with M&A down the road for our companies that then sell to those public companies. So investors in the asset class are getting a lot of liquidity, and we're seeing good multiples in the public market.
So let's talk about that, because we've been breaking down this report from the U.S. House on big tech recommending breakup of these big companies. Do you, as an investor, think that Apple, Google, Facebook, Amazon, are they monopolies and stifling innovation?
Well, in some ways, yes. In other ways, no. As a technology investor, we look for businesses that are what we call natural monopolies, have network effects. So if you take Google's core search engine and that business by itself, for instance, there are network effects in that business. If you split that up, it would go back to a world where there'd be one dominant search engine. However, I guess the anti-competitive piece is the bundling of other apps along with core search, like YouTube plus search, where Google drives traffic to its owned and operated sites. And I do think that's anti-competitive behavior.
So what should be done? Should they be broken up?
It's tricky. Ultimately, if the government comes in and breaks up Google into multiple business units, in a way, Alphabet already is a collection of multiple businesses. I guess you could spin it off and they do commercial deals. I guess that's one path forward. Reading through what the House has suggested, however, it was far beyond that. And it included things like prohibiting Amazon from selling manufactured products on its own marketplace. And I think, the question is, where do you draw the line, Emily? Because, Walmart has been selling owned goods for decades. And are we going to prohibit retailers from selling products they manufacture if we think that's anti-competitive?
So talking about one of your former portfolio companies, which is Venmo, launching a credit card to compete with Goldman's Apple Card, some of the concerns about Apple have been around its payments product. What is your take on this development and whether Venmo can and should compete with Apple?
So Venmo was an amazing business. We invested, probably 8.5 years ago now. And then we sold it to Braintree, and then we invested in Braintree, and then PayPal, which at the time was owned by eBay, bought the combined company for $800 million. Back then, Venmo was still relatively small, millions of monthly actives. It's now 60 million monthly actives. Venmo was really the first mobile fintech app, mobile consumer fintech app. And for the better part of 5 or 6 years, very little has happened to Venmo. They've just tried to scale it, and scaling it has been hard enough because 60 million monthly actives requires a lot of work and fraud prevention and detection. But if you look across the venture landscape, we're in Acorns and we're in Public, and there's Nuvo banks like Chime out there. And those companies exist in part because Venmo hasn't added those features to its core platform. And now PayPal is going to invest more in consumer fintech to catch up with Apple, and we'll see if they're successful. I use Venmo every week, but I use it for payments. I don't use it for checking out at a local retailer. And I just think that behavior change is probably outside the scope of what most Venmo users will regularly do with a product.